On behalf of Professional Development Committee of the Western India Regional Council, the Institute of Cost Accountants of India, I welcome all of you for the first sessions of the webinar series for the UPSC ICOS preparation for newly qualified cost accountants. Our today's session is generally accepted cost accounting principles, cost accounting standards, cost audit companies rules 2014, cost auditing and assurance standards. I welcome our today's speaker, former President CMA Amit Apte sir, our WRC Chairman CMA Chaitanya Morir sir, and our WRC Secretary CMA Mihir Vyas sir, and all the participants. Now I request WRC Chairman CMA Chaitanya Lakshman Rao Morir sir to kindly address the participant.
Hello all, good evening. Uh, I'm very happy that WRC has announced, the Professional Development Committee of WRC has announced the webinar series for UPSC and specifically for ICOAS preparation for newly qualified cost accountant. So this examination, very few of us are knowing about this examination, and we thought that we should give some kind of input, we should give some kind of inputs and preparation material for all of us. That is the reason we have kept this webinar series. This we will be covering entire syllabus of the ICOS examination. Uh, the shortlisting criteria for the ICOS examination is there is a written test for 300 marks and an interview for 100 marks, which is there as per the notification given on the 8th January 2022. So we will in this complete entire series we will be covering for the 300 marks syllabi. Uh, uh, if we can go to the syllabi, so today's session is generally accepted cost accounting principles, GACAP, cost accounting standards, cost audit. So majorly all the syllabus are related to costing and cost audit, which we have learned in our CMA syllabus. And in this entire web series, we will be definitely getting one or two CMAs who has cleared this examination and they are working in the ministry. So I was just checking. So these ICOA services are required in the 31 ministries. So 31 ministries basically require the services of ICOA, Indian Cost Accounting Services, and getting qualification in ICOS will definitely help to serve our nation as well as our institute. Um, as I said, today's session is on generally accepted cost accounting principles, cost accounting standard, cost audit, companies record rules 2014, and cost auditing assurance standards. So when we thought of this topic, the first name came in my mind and Arindam Bhai's mind is Amitabh Sir. Amitabh sir is our dynamic past president, and I'm really thankful to Amitabh sir for his for accepting this our invitation for this session. Thank you, Amitabh sir, and I'm very much sure that he will guide us on the given topic. I know the topic is we have to just cover this topic in 2.5 hours or 2 hours. But definitely Amit sir will touch upon all the concepts given all the concepts on the topics. And I wish all of you for a happy learning. I'm also thankful to PD Committee Chairman Arindam Goswami, who is not able to attend this session because he is traveling as on today. But I'm really thankful to him for taking lead to arrange this program. Thank you. Thanks a lot.
Thank you, sir. Now I request our WRC Secretary CMA Mihir Vyas sir to kindly address the participants, sir. Mir sir?
Pujanka, I think he is not there in the call.
Okay.
We can
Okay.
directly go
Yes,
with
yes.
the Amit sir's presentation.
Okay. Thank you, sir. Okay. Our today's speaker is CMA Amit Apte sir. He has over 26 years of post-qualification experience in the field of costing, MIS, finance, and accounts and ERP system implementation. Sir was a former president of the Institute of Cost Accountants of India for the year 2018-19. Also, he is a chairman of the Western India Regional Council in 2010 and 11. Sir was a Central Council member of the Institute of Cost Accountants of India for the term 2011 to 2019. He is a director of a Lever Consultants Private Limited and Lever Info Solutions Private Limited. Also partner of Joshi Apte and Associates, a firm of practicing cost accountant. Sir is a member of the Independent Evaluation Committee constituted by the IBA under RBI's framework for revitalizing distressed assets in the economy. He is a member of RBI Committee on Cost of Government Banking, received special acknowledgements of efforts and contribution. Sir has secured All India ranking in the ICMAI-CMA final examination. Sir has a global exposure of 3 years of overseas stints in UAE and Egypt. Sir has completed independent trek of several Himalayan destinations, including Mount Everest Base Camp. He represents state level and meritorious performance at table tennis tournaments. I welcome sir, and now I request sir to kindly start the session, sir. Thank you.
Thank you, Pujanka madam. Is
Thank
my
you, sir.
screen is my screen
Yes, sir.
visible?
Yes, sir. It's visible, sir.
Yeah. So thank you, Chaitanya Morir, and all the participants for today's program. I can see a very senior cost accountant, Kailash Bhai, also there amongst the audience. So the topic that was given to me was the company's cost records and audit rules 2014, the generally accepted cost accounting principles, cost accounting standards, and also the cost auditing and assurance standards. So first of all, let me congratulate WRC for thinking out of the box and coming up with this series, which will help some of our members who are willing to appear for the examination of UPSC for the Indian Cost Accounting Services preparation. And all the best to those aspiring members. Let me have a couple of disclaimers over here. I have roughly about 2 hours in this session, and the topics that have been given to me are a bit elaborate. And if I have to really give justice to all of them, maybe a full day session would have been enough. So what I am planning to do today is I will be covering the the company's cost record and audit rules 2014, the GACAP, and the cost accounting standards. And the cost auditing and assurance standards will be taken up on some different day, because otherwise it will be too cramped up a session. The second thing which our chairman Chaitanya has already touched upon is that I may be considered having some good knowledge on these topics. Also, being the former president, I do have access to some information which may not be in the public domain. But at the same time, let me confess that I have never ever appeared for any UPSC exam in my career, and that is why I may not be able to guide the audience as to how to prepare for the UPSC examinations. So this matter was discussed with WRC, and they have in fact already identified a couple of cost accountants who are already cleared this examination and already serving with the Indian government. And they will be having one full session on how to prepare for the exam and what to expect in the examination. So I think that would be a very good exercise for everyone of us to attend. Now, coming to the topic, I will start from the brief history of our institute itself, because even though all of you are cost accountants, the topic of cost audit is something which has a history of our institute as well. So many of you may be already aware that our institute was basically formed during the Second World War, and it was registered as a registered company under the then Companies Act in 1944. Even though the object of the institute at that time was promoting, regulating, and developing the profession of cost accountancy, there was a very clear agenda. It was the World War II which was going on there, and the British government had given contracts to many manufacturers for various arms and armaments in India, and they needed someone who was trained in cost accountancy to certify the various costs that are being incurred by the various manufacturers of the arms and armaments. So that is how the institute was basically constituted. And of course, we all know that later on in May 1959, it was enacted in the Special Act of the Parliament. There is the Cost and Works Accountants Act 1959. And in 2012, we were renamed as the Institute of Cost Accountants of India. The other things like the head office, the regional office, and the chapters is known to everyone, so I will skip that. Now, as far as the history of cost audit is concerned, so our institute was always constituted primarily to certify the cost after due diligence. But the concept of cost audit was introduced only in 1965 when the Companies Act 1956 was amended, and the cost accounting rules and cost audit provisions were introduced. So the cost accounting and cost record rules, not rules, but the provisions for that were introduced under section 2091D, and the provisions relating to cost audit were introduced under the section 233B. Then one by one, various industries, as many as 44 industries were covered under cost audit, but never ever were all the companies under those industries were covered under cost audit. Always the cost audit orders used to be to individual companies. So for example, if we take the automobile industry, there could have been cases wherein one company was covered under cost audit, but the other company was not. Also, there was a specific requirement of physical submission of the cost audit reports, which also was a cause of some concern. Someone, can you put him on mute?
Yeah. Yes, sir. Yes.
Yeah. So the physical submission used to be a major pain, not only for the cost auditors, but also the companies had concerns about the secrecy of their information. So sometime in 2010-11, there was a empowered committee constituted by the government. And based on the detailed report of that empowered committee in 2011, the rules and the reporting formats were overall simplified to address the overall industry concerns of confidentiality as well. Also, the industry applicability was rationalized. XBRL was introduced for the first time for submitting of the cost audit reports. And instead of having individual industry-wise cost accounting rules and record rules, the principle-based concept of cost accounting was introduced for the very first time. The Companies Act 2013 has retained the provisions relating to the maintenance of cost records and cost audit. It is mentioned in the section 148 instead of the erstwhile sections 2091D and 233B. So we have a separate section for maintenance of cost records and the cost audit. The 2011 rules had some resistance from the industry, And after a lot of detailed deliberations with the government, the rules were once again modified, and in 2014 the revised rules under the Companies Act 2013 were given by the government. So basically, what are the objectives of cost audit? Now the objectives of cost audits are many. So the first and foremost objective of the government was always to give a regulatory push to the overall Indian companies to have at least a minimum level of cost management systems implemented, because that time government was pushing the Indian industries to be global players. There was also a TCM movement of the Confederation of Indian Industries to inculcate the cost consciousness across all sectors in a structured manner. And these rules of maintenance of cost records have gone a long way in boosting that movement of CII. There was an intention to attain an overall higher level of maturity in the cost management, and cost competitiveness was always the forefront of the objectives. Also, these rules, since they were principle based, they brought about uniformity and standardization in the overall cost ascertainment, and this has definitely benefited the government, the various regulators, and also the industry. The rules in 2011 mandated that the generally accepted cost accounting principles and the cost accounting standards are required to be followed. And one more objective of the rules was to help the companies to have control over their activities and their costs, which naturally would lead to optimum utilization of resources, which is always the base for all the costing exercise. Now, there are certain differences between cost audit and financial audit. Whenever we visit various companies, also many in the department ask as to what is so different in the cost audit exercise than in the financial audit exercise. So I have just given a few pointers. So basic cost audit is an independent examination of the correctness of the cost statements and their conformity with the cost accounting principles. Whereas the financial audit has always been an independent examination of only the financial books and records and expression of the opinion of the auditor on them. So cost audit is always performed only by practicing cost accountants against chartered accountants for financial audit. One major difference is that about the appointment of the auditor. So the appointment of the financial auditor is done in the general body meeting of the shareholders, whereas for cost accountants, the cost audit appointment is done by the board of directors, and only the fees of the cost audit are ratified in the general body meeting of the shareholders. Overall emphasis is the analysis of the efficiency of operations and propriety of actions of the management, whereas financial audit primarily focuses on the compliance with the accounting standards and the effectiveness of the internal control systems. Also, financial audit is compulsory for all the companies, whereas cost audit, as we all know, is specified industries and also which meet the turnover criteria are covered under the cost audit. The submission of the report is done to the board of directors in case of cost audit, and whereas in financial audit, of course, it is submitted to the board, but final presentation is to the shareholders. Whereas being sensitive information, the cost audit report never goes to the shareholders. Now coming to the applicability as it stands now, as I mentioned earlier, the entire applicability is based on only two factors. One is what is the industry, and number two, what is the limit of the turnover. So the record rules and the cost audit rules 2014 have prescribed as many as 6 industries under the regulated sector and 33 industries under the non-regulated sector that should be covered under the cost audit. Apart from the specifications of the regulated and non-regulated sector, specific CTA headings are also given. CTA is the customs tariff. For example, arms and ammunitions is covered under the non-regulated sector. That does not mean that each and every product which comes under the arms ammunitions will get covered. Whether the products of the company are also covered under the CTA headings that have been given in the rules has to be seen when we give our opinion on whether the applicability is there for a particular company or otherwise. So majority of these companies are, or the majority of the industries are primarily the manufacturing and a few service industries as well, except serial number 33 in the unregulated sector, wherein even the trading activity of certain medical devices is covered under the ambit of record maintenance and also the cost audit. So under the medical devices, cardiac stents, drugs effluent stents, catheters, bone cements, and there is a list of some 19 different devices which are covered. And cardiac stents is something that we are all aware of, that earlier the cost of angioplasty used to be in a few lakhs. But after government mandated certain threshold limits beyond which you cannot charge for the stents, the angioplasty is now possible in much less than 1 lakh rupees. And it is all because of the inputs that the government has received about the cost of those stents. Then once a particular company is manufacturing certain goods or rendering certain services in a particular industry, which is basically covered under cost audit, then comes what is the threshold turnover limits for applicability of the cost audit. So maintenance of cost records in case of a regulated sector, if the gross turnover of the company which manufactures the products and services which are covered is 35 crores. In case of regulated as well as non-regulated industries, it gets covered under maintenance of cost accounting records. As far as cost audit is concerned, the threshold limits are different for regulated sector. So the gross turnover of the company has to be 50 crore. And the turnover of the products and services covered for maintenance of cost records has to be 25 crores. If it's a non-regulated sector, then the gross turnover of the company should be 100 crores, and the products and services being covered for maintenance, the turnover should be at least 35 crores. So if the industry is also getting covered, the CTA is also given in the list, and also the threshold limits, then the maintenance of cost audit and the cost audit applicability will come into force. Of course, there are certain exceptions. Micro enterprises, small enterprises, and foreign companies having only liaison offices are excluded from the purview of cost. I do not know why this is going ahead then automatically. Anyway, so the export-oriented units and the SEZ are exempted from cost audit. Also, the captive power generation plants are excluded from the purview of cost audit. And the term captive generating plant has been defined in the Electricity Rules 2005. For non-compliances, there are penal provisions. So company is punishable with a fine which shall not exceed 25,000 rupees, but which may extend up to 5 lakh rupees. The individual officer who is responsible for the default is also punishable with imprisonment and fines. And some of the examples of defaults is basically the non-maintenance of. Just give me a minute. Let me just fix this. Yeah, I hope my screen is now once again visible.
Yes, sir.
Yeah. So some of the examples for defaults under the provisions are like non-maintenance of the cost records, or the cost auditor not being appointed by the company within the stipulated time, the cost audit report not being approved within the specified time, and the cost audit report, even though approved, has not been submitted to the central government. So there are specific provisions for the compliances as well. So the appointment of the cost auditor has to happen within 180 days from the beginning of the year for which the cost audit is applicable. The cost audit report has to be approved within 180 days of the end of the financial year for which it is applicable. And once it is adopted in the board meeting, within 30 days, the filing has to be done in the XBRL format. So if the company fails to satisfy any of these timelines, they stand to be some action can be taken. And last couple of years, we are observing that the Ministry of Corporate Affairs, the cost accounting branch, has been regularly issuing a lot of cost audit related notices for non-compliance of the act, which is a encouraging sign. And the overall awareness of the cost audit is naturally getting benefited because of these notices. Now, the maintenance of the cost records as per the rules dated 2014 has to be done in CRA 1 format. And the overall maintenance has to be done in such a way so as to facilitate the calculation of the per unit cost of production, the cost of operations, the cost of sale, and also the margins for each of its products and activities for every financial year. And the cost records are to be maintained in such a manner so as to enable the company to exercise control over the various operations and cost to achieve the optimum economies in utilization of the resources. Also, the cost audit is basically the verification of the cost accounting records to ascertain the overall accuracy of the same and the compliance to the cost accounting principles, procedure, and standards. As I mentioned already, the appointment of the cost auditor has to happen within 180 days of the commencement of every financial year. Before appointment of any cost auditor, the board has to satisfy itself about the eligibility and the disqualifications of the cost auditor. And so they essentially have to obtain a certificate from the cost auditor as to whether he or his firm is eligible for appointment and is not disqualified for appointment. Then whether the various criteria given under section 141 are being satisfied, 141 of the Companies Act 2013. Whether the appointment is within the limits as laid down by any authority under the Act, and whether any proceedings against the cost auditor or his audit firm or any of the partner of the audit firm are pending in, with respect to the professional matters of conduct has to be disclosed very clearly to the board. So once the board approves the appointment, the CRA2 form has to be filed with the MCA within 30 days of the board meeting, and the auditor has to be issued a formal letter of appointment as a cost auditor. So remuneration of the cost auditor has to be based on the recommendations of the audit committee wherever the company is required to constitute an audit committee, and it is ratified by the shareholders. And wherever there is no audit committee for a company, then the appointment as well as the remuneration is fixed directly by the board. But in this case also, the remuneration has to be ratified by the shareholders subsequently. The audit timelines I have already mentioned, that the annexure to the cost audit report is to be prepared by the company and approved by the board before handing over to the audit. And the cost auditor shall submit the audit report along with reservations or qualifications, if any, in the prescribed form CRA3, and the cost auditor shall forward the report to the board within a period of 180 days from the closure of the financial year. So if there is any company having its year ending on 31st of March, typically the last day for adoption of the annexes to the cost audit report and adoption of the cost audit report are 27th of September. The board of directors, particularly if at all there are any qualifications or reservations in the cost audit report, the board of directors are required to go through those reservations and give the response of the company, and the cost audit report along with the response has to be submitted to the MCA in the XBRL format within 30 days of adopting the same in the board meeting. Now, there are several affirmations in the cost audit report. One of the main affirmations is that the cost audit has to be done as per in compliance with the cost accounting standard. Not the cost accounting standard, my apologies. It is the cost auditing standard which is issued by the institute. And the affirmations are specifically, there are 7 affirmations that are required to be made. So the auditor has to specifically report whether the all the information and explanations which are necessary for the purpose of the cost audit have been given to him by the company to his satisfaction. Whether proper cost records have been maintained by the company in respect of the products and services that are there under reference. Whether proper information and returns have been received from various branches which are not visited by the auditor. So typically a company can have several branches and several manufacturing units, and the auditor may not have visited each and every branch or unit or manufacturing unit of the company, but then he has to ensure that the information that is required for the purpose of cost audit is received in the format which is required for cost audit. Then the books and records have to give all the information which is required by the Companies Act 2013, and the auditor also has to comment whether the company has adequate system of internal audit of cost records, which has to be commensurate with the overall nature and size of the company and its business. The information and the statements in the annexures to the cost audit report, whether they give a true and fair view of the cost of production of the products or the services, the cost of sale, margin. So it's not about the individual product-wise data, not in totality, but also product-wise has to be certified by during the course of the cost audit. So even though the reporting to the government is CTA heading wise, the cost records have to be maintained individual product wise and then clubbed together CTA wise before submitting it to the government. The seventh and the last affirmation talks about the unit wise and the product or service wise cost statements and schedules. There too in respect of the products and the reference whether they are kept by the company. So as I said, even though filing with the government is always CTA wise, the unit wise and within the individual unit product or service wise cost statements have to be maintained, and the government can call for that information at a subsequent date. Now, basically what all constitutes the cost records. So cost records is nothing. It's a part of the overall books of accounts that are required to be maintained by the company. And individually, cost records will contain details about the material cost, so the stores ledgers, then the employee costs like the pay sheets. So pay sheets are also a part and parcel of the cost records. The units manufactured and units purchased of various utilities and the cost associated with the manufacture and purchase. Direct expenses individually identified product wise. The various other cost components like the repairs and maintenance, the depreciation, transportation cost, royalty, R&D expenses, quality control expenses, the pollution control expenses, packing costs. So each and every cost component has to be accumulated individually product wise, and it becomes part and parcel of the cost records. Apart from this, various other records are also required to be maintained by the company, like the capacity. So what is the capacity of the various products under cost audit? What is the capacity utilization for individual product? What is the working in progress and the finished stock, the basis for valuation of the work in progress and the finished stock? If at all there is any captive consumption, details in terms of quantity as well as cost for the captive consumption, byproducts and joint products. The adjustment for the cost variances. So there will be cost variances, but then how are they adjusted to individual cost components? Whether those variances are within reasonable limits or there are any abnormal variances. Then there is always a reconciliation statement between the profit or loss as per the cost records and the profit and loss as per the financial records. Details of the related party transactions, particularly details of any material purchased or sold, or any service received or rendered has to be given for each and every product and service separately. Then any incentives on exports or any subsidies have to be recorded individually. In this production records, the sales records, both in terms of quantity as well as value. And finally, the basic cost statements, the records of the physical verification of the stock done on the last day of the year, and the various annexures to the cost audit report are all part and parcel of the cost records. So there are instances when we are required to certify whether a company has maintained the cost records. And some of the companies take a stance that we have our stores ledger, we have our payroll, so which means that we are maintaining the cost records. So it is not as simple as that. The various other cost components that I have mentioned and the various other records which I have mentioned in this slide are also to be taken into consideration whenever any certificate as about the maintenance of cost records is given to any of the clients. Now coming to GACAP and CAS, that is the generally accepted cost accounting principles and the cost accounting standards. The company's cost accounting record rules 2011 had a specific requirement that the cost records shall be maintained in accordance with the generally accepted cost accounting principles, that is the GACAP, and the cost accounting standards, that is the CAS, issued by the Institute of Cost Accountants of India. However, so basically, after this provision came in, at that time there were, if I remember, 13 cost accounting standards already in existence, but there was no document as the generally accepted cost accounting principles already there in place. So Institute on a war footing went about a detailed exercise, and they compiled the generally accepted cost accounting principles, and they also moved ahead to go beyond the cost accounting standard number 13, and today as many as 24 cost accounting standards are there in place. Of course, all these cost accounting standards are continuously evolving, and based on the inputs received from the industry and the research of the institute, they go revision on time-to-time basis. So the cost accounting standard on the capacity utilization has gone about 2 or 3 iterations till date, and similarly, a few other standards have also been modified over the period of time. However, the company's cost record rules 2014 do not find any mention of the GACAP or the cost accounting standards. So what the rules 2014 mention is that every company under these rules, including all units and branches thereof, shall, in respect of each of its financial year commencing on or after 1st of April 2014, shall maintain cost records in the form of CRA1. So CRA1 is something which is defined in the rules 2014 itself, and the rules mandate that the cost records should be maintained as per CRA1. So we have undertaken a detailed exercise whereby a comparison between the various cost accounting standards and CRA1 was done. So basically CRA1 is more or less the cost accounting standards itself. In fact, the CRA1 also has reference to the cost accounting standards at quite a few places. And the generally accepted cost accounting principles are the backbone of all the cost accounting standards. So all the cost accounting standards have been basically prescribed based on the generally accepted cost accounting principles. So we'll come to that in the next few slides. So even though the specific mention to the generally accepted cost accounting principles and the cost accounting standards has been done away with in the rules 2014, the CAS does find a place at a few places in CRA1. And apart from this, the institute has also come up with the cost auditing and assurance standards, which also mention that as a part of the audit and assurance exercise, it is the duty of the cost auditor to ensure that the company is maintaining the cost records as per the generally accepted cost accounting principles and the cost accounting standards. So the GACAP document and the cost accounting standards, which are available as on date, still have some relevance, or no, I would not say some relevance. They are still very much relevant in the overall cost accounting and the cost audit mechanism. So coming to the generally accepted cost accounting principles, that is the GACAP, they were released by the institute sometime in 2011 or 2012. And these were recommended by the Cost Accounting Standards Board, which is the standard setting body of the Institute of Cost Accountants of India. These are also approved by the Central Council of the ICMAI. And as a principle, all these documents which are recommended by the CASB board and approved by the council are also unofficially vetted by the cost audit branch of the Ministry of Corporate Affairs before they are released or before they are mandated for use by the industry and the cost accountants. Now, the background of the GACAP, so basically, even though this document of GACAP was is very recent, maybe 10, 12 years ago, there have been a lot of references to the overall principles of cost accounting in various other documents prior to 2011. So I have listed out some of the documents. The defense contract accounting in the US. So there is a cost accounting standards board in place in the USA, and some of the cost accounting standards, specifically in the context of the defense contract costing, are in existence in the US for quite some time now. Then the right from 1950s, various tariff commissions were constituted by the government of India, and the tariff commissions were mandated to fix the tariff and prices in a variety of industries. And each of these tariff commissions has come up with a set of rules and principles based on which the costing of their relevant industry is required to be done in order to compile the cost records. Then when the cost audit mechanism was introduced in 1965, as I mentioned, there were as many as 44 industries to which the cost accounting was made mandatory and the cost audit was mandated. And each of these 44 industries, there were separate rules for each of the industries. So there was a separate rule for the steel industry, separate for automobile industry, and so on and so forth. And these rules carried nuggets of the various cost accounting principles in the body of the rules. So even though so one of the major difference between pre-2011 era and post-2011 era has always been that prior to 2011 it was a rule-based maintenance of cost records, whereas after 2011 we have shifted to principle-based maintenance of cost records. But even in the rule-based era, many of the rules were always based on certain cost accounting principles. So the various price fixing authorities like the Fertilizer Industry Coordination Committee, Drug Price Control Authority, the Central Electricity Regulatory Commission, TRAI, all these were having their own set of rules for fixing the price, which were all based on the cost records to be maintained by respective companies, which were being regulated by these regulatory authorities or the price fixing authorities. So the expert group which was constituted by the ministry in 2011, even if you have a close look at the report of the expert group, they have acknowledged the existence of an uncodified set of generally accepted cost accounting principles, and they mandated that perhaps the time has come that that the generally accepted cost accounting principles be documented as a single set of generally accepted, or the GACAP, as they are popularly known. And based on their suggestions, all the principles which are there in various pockets were accumulated as a single document that is called as the GACAP document. So the GACAP document is basically, it gives the formal basis for the practice of cost accounting from 2011 onwards. So the objective of codifying the GACAP or coming up with a document for the institute was basically to codify the GACAP. And there were naturally some diversities in the various cost accounting practices being followed by various industries. So the gap between the various diversities had to be narrowed down so as to facilitate the process of development of the cost accounting standards. So the GACAP document, one more objective was always that they should serve as a reference source where specific cost accounting standards are yet to be issued. So as I mentioned earlier, when the GACAP document was notified by the institute, there were only 13 cost accounting standards in vogue. So till the time the additional cost accounting standards were put into place, wherever there was no specific cost accounting standard for a particular cost element, the GACAP document has to be referred while compiling the cost of those cost elements. Then another object was to provide a reference source in the understanding and interpretation of the cost statements, and to monitor the evolution of the new concepts and practices in cost accounting, to codify them as and when they become generally accepted. So GACAP document is also futuristic in nature. So as and when some new concepts come, because the industry has been evolving, and new concepts like the industry 4.0 and all those concepts are being introduced at quite a fast pace. So the GACAP document also gives a leeway for all those new concepts which are coming in, and they can be codified as and when they become generally accepted. So the overall content and the format of the GACAP document is that it's as I mentioned already, it's a summary of the various cost accounting principles. And it explicitly incorporates the principles already contained in the cost accounting standard number 1 to 13. Not only the cost accounting standards 1 to 13, but it also fine-tunes the various principles that have been laid out in the 44 industries and the industry-specific cost accounting record rules, which were already there in place till the time the new rules came in 2011. And this is nothing but an overall attempt to harmonize the principles where somewhat conflicting principles were laid by various cost accounting record rules, because 44 different industries had 44 different rules, and there were definitely conflicting principles which were all done away with, and a single principle was established in the form of the GACAP document. So the GACAP document reflects the current concepts. It is, as I mentioned, it is also futuristic in nature. They also contain the guidance notes and the other publications issued by the institute from time to time. The cost accounting principles which had already gathered widespread acceptance in the Indian companies were all accumulated to come up with this document. So the overall till now I have mentioned the overall concept of the why this GACAP document was necessitated to be compiled, and the overall history of how it came into existence. Now, over the next few slides, let us discuss about the overall conceptual framework of the GACAP. What are the various principles that have been laid down in the GACAP document? So the overall focus of the GACAP document was that the costing has to present an informed understanding of the organizational drivers of cost, revenue, profits, and the value, not just in the historical but also the forward-looking context. The external reporting always requires historical and full absorption costing, whereas the performance evaluation of any company will always require the attention, directing, and diagnostic information about the costing. And for the management decision-making process will always require the analytical and the predictive information. So all these three requirements for the external reporting, the performance evaluation, and the decision making have been taken care of in the generally accepted cost accounting principles. So the GACAP is always the reality driven. So the cost models must reflect the entity's business model, its operational processes, the strategy, and the organizational structure and its competitive environment. There is a need to balance the cost of maintaining a cost accounting system corresponding to the benefits. So what the GACAP document clearly mentions is that any costing system that is implemented in a company has to be implemented in such a way that it has to be economically feasible. So the cost benefit analysis has to be done while we allocate the various costs, while we identify the various abnormal costs, and so what is the cost of maintaining that kind of record versus whether we are following all the principles has to be always seen. So the expression economically feasible way has been used in this document at quite a lot of places. So the cost records have to be comparable over a period of time. So naturally, they have to be consistent. So the principles that have been laid down and followed for a particular year have to be followed year on year. And if at all there is any deviation in the principles that are being followed by the company, those have to be clearly disclosed in the cost records. That is the one of the prime principles of the GACAP documents. Also, as you maintain the cost records, there has to be a traceability and the auditability of the cost information. So the records have to be maintained in such a fashion that as and when the records undergo the cost audit mechanism, each and every figure which is being reported in the final annexures has to be traced to its source. So the entire document becomes auditable. Wherever the companies are following the standard costing mechanism, the variances due to the normal reasons are always treated as a part of the cost element wise cost. So for example, as and when we do the costing exercise, if we do the material valuation based on the bill of materials and the standard rates, a comparison is normally done as to the material consumption as per the financial records, and it is compared with the standard cost which has been worked out based on the costing principles, and a variance is worked out. So if this variance is within the normal tolerance limits, it is loaded onto the standard cost, and then the standard cost is reconciled with the financial cost and then reported in the various cost statements. At the same time, any variances due to abnormal reasons will never form a part of the cost. For example, any batch is spoiled due to production or a plant shutdown, some additional costs are incurred, or especially in chemical industries, there are instances wherein the sorry. Yeah. I think someone needs to mute. Yeah, thank you. So any variances due to such abnormal reasons should not form the part of the cost. That is the basic principle of costing. Then any subsidies, grants, or incentives that are received or receivable with respect to the input cost is always reduced from the cost. So there are companies, for example, manufacturing agricultural products, wherein government offers several subsidies to the input material that is being used, and some part of the material cost is reimbursed by way of grants or subsidies. Then the costing principle says that these subsidies or grants should be netted off against the input cost or the material cost in this example while reporting the cost in the cost sheets. Also, the abnormal cost where it is material and quantifiable should not form a part of the cost, and it should be reported separately in the P&L reconciliation statement. So material and quantifiable are the two keywords here. So as we go about a costing exercise or during the cost audit also, the overall materiality has to be seen, and whether those abnormal costs are quantifiable in an economically feasible manner has to be seen before insisting that those have to be reported as a part of the reconciliation exercise. Similarly, the principle is that no business is done for paying penalties and other interest on delayed payments to the statutory authorities. So any kind of penalties or damages or demurrage is always excluded from the cost and reported as a reconciliation item. One more principle, which, sorry. You have any question?
CC madam, can you mute yourself?
Yeah, thank you. So the cost will not include any notional cost. That is the underlying principle laid down by the GACAP document, and which finds place in all our cost accounting standards as well. Also, any finance cost which is incurred in connection with the acquisition of the resources will not be part of such resources. So I can quote an example over here. In case of material procurement, suppose a large consignment is being imported, and the company has given a LC against that procurement. Now, the cost of this LC is essentially a finance cost, and the standards or the generally accepted principle says that this finance cost should not be included in the cost of the material, but should be reported separately as the finance cost. Also, credits or recoveries from employees or suppliers and other parties should be netted off against the cost. So a classic example over here is that we have staff related expenses like a canteen facility. So the canteen facility is always the cost towards the canteen facility is reported as employee benefit cost. So if at all there are any recoveries being made from the individual employees towards this facility, has to be netted off against the expenses of canteen and then reported in the cost sheets. Depreciation is one item which typically mirrors the practices that are followed in the financial accounts. So the depreciation which is reported in the financial accounts normally is also taken as the basis for the cost records. However, the cost accounts will always use the depreciation computed on the period of use basis. So if it is estimated that a particular asset, the useful life of that asset is say 10 years, then typically depreciation is charged over equally over a period of those 10 years. So if at all there are any companies following the written down principles, then the depreciation as per written down principle is normally not to be considered when we consider the depreciation in the cost records. Then the entities, there are entities which charge 100% depreciation in the books of accounts in certain cases. So in such cases, as cost accountants, our underlying principle is that we should be charging the depreciation over the estimated life of that asset. So naturally, in cases where the company has charged 100% depreciation in against any particular asset, and if the life of that asset is 2 or 3 years, so in cost records we should normally consider the depreciation over the period of 2 to 3 years, which is the estimated life of that asset. Also, in cases where fully depreciated assets are still being used, so the book value of that asset is nil, but the asset is still being used and for the production purposes. Then notional depreciation, there is a provision for notional depreciation of such assets for costing purposes. So the underlying principle which I mentioned over here, that the cost will not include any notional costs. But this is one iteration to the basic principle, and in cases where any asset which is completely depreciated is still being used, the company can choose to have a depreciation for the balance life of that for that asset. In fact, the company can also revalue the asset for the purpose of costing so as to reflect the true cost of depreciation. Naturally, there will be a difference in the depreciation that is charged as per the cost records and the depreciation that is charged as per the financial records in such cases. And such differences have to be clearly disclosed and also reported in the P&L reconciliation statements. Depreciation on common assets are, as a principle, are apportioned to individual cost centers on some suitable basis. So depending upon what the common assets are, we have to derive a suitable basis and then charge the depreciation to individual cost centers based on those basis. And finally, there is no mention of in the GACAP document about the depreciation charged based on the estimated output of the asset. So we have always, especially in case of fixtures and certain tools, the life of those tools is sometimes estimated based on, for example, in a forging industry. The tool's life can be 1 lakh strokes, and typically it is depreciated over a period of those 1 lakh strokes. Instead of the time element, it is the utility element which is taken into consideration. But the GACAP document does not mention depreciation charged based on the estimated output of the asset. But this is very much relevant and a practice which is used, especially in industries which uses assets based on their utilization. As I mentioned earlier, the interest and finance charge should not be charged to individual cost elements, and they normally are as a principle not included in the cost of sales, but they are never included in the cost of production. So interest and the finance charge is should be always reported as a separate line item after the cost of production. Typically, the interest charges are grouped under the interest on long-term funds and interest on working capital funds. So the company could have a long-term loan for setting up a plant, and they could have a working capital loan for taking care of their day-to-day working capital requirements. So the allocation of the interest component to individual cost centers and further to individual products, there will be a difference between the interest on the long-term funds, which typically will be based on the assets which have been procured using the loans, and the interest on the working capital funds will also be required to be computed based on the purpose why the CC limit has been taken. So the typically the interest on the long-term funds is assigned to product lines based on the fixed asset investments. So a particular cost center which has higher capex will naturally be charged with higher interest because the interest on the long-term funds. And as far as the working capital is concerned, the bifurcation of the total working capital requirement should typically be done in between the raw material stocks, the other stores, work in progress and finished goods, and the debtors. And the interest component, which is relevant to the raw material stock, should be charged to individual products based on the raw material consumption. Then the stores of high value items can be directly charged to individual cost centers, and the balance can go as the stores consumed and allocated to individual cost centers on certain basis. Work in progress and finished goods can be allocated to individual product directly because we know the value of the opening and closing values of the work in progress and the finished goods. And same with the debtors can be allocated to individual products based on the sales of those individual products, gross sales. The GACAP document also very clearly highlights the way presentation and the disclosure is required to be done. Even though no model statements or the formats are given in the GACAP documents, the document does give a methodology as to how the various cost records and the disclosures that are required to be made along with the cost statements. So the document says that the cost statements must contain the total cost, the unit cost per unit of the output. So the production and the sales quantities of individual products have to be mentioned, the total cost of production and cost of sales, and the per unit cost of production and cost of sale has to be coming out of the cost statement of individual products. Then the unit of measurement of the output quantities must also appear very clearly, must be disclosed in the cost statements. The input costs are also to be broken up into quantities and rates. And the basis of valuation of the inputs must be clearly stated and disclosed as a footnote to the cost statements. So as the basis of distribution of cost to the various cost objects. So if we have used various bases for allocation of the individual cost elements to different cost centers and then to cost, they should find a place in the cost accounting policy of the company and clearly disclosed as a part of the annexure to the cost audit report. Any costs which are incurred in foreign currency have to be reported separately. So even in individual cost statements, the material cost is bifurcated between domestic purchases and imports and disclosed separately. Any costs which are not forming a part of the cost statements have to be disclosed separately. These will be disclosed under the P&L reconciliation statement. Similarly, any credits or recoveries which are netted off against cost have to be disclosed separately. And the transactions with the related parties have to be mentioned separately. So if you look at the various annexures to the cost audit report, you will easily find that the various annexures to the cost audit report are basically designed so as to adhere to the generally accepted cost accounting principles. So we have the quantitative reconciliation in the form of the capacity available, the additions to the capacity, the deletions to the capacity, the actual production. So the entire annexure is given in the which takes care of the quantities and the unit of measurements. Then the consolidated cost statements give you the details of the production quantities, their unit of measurement, the sales quantities, the opening and closing stocks. Then the total cost element wise divided by the quantities gives the per unit rates. Then the material cost is disclosed as a separate annexure to the main cost sheet, wherein any material which is of significance more than 5% of the total material consumption, the quantity, rate and value is disclosed separately. So the requirements of the various annexures, then there is a separate annexure for the related party transaction. There is a separate annexure for cost accounting policy that is being followed by the company. Which also takes into consideration, there is a separate para in the cost accounting policy wherein any changes in the costing principles as compared to the previous year have to be separately disclosed in that annexure. So as a conclusion, we can say that the overall GACAP document contains a discussion on the generally accepted cost accounting principles in the context of today and times gone by, because it has referred to the various earlier rules and regulations which were there in vogue. But it must be understood that the cost accounting principles and the methods of applying them are constantly influenced by fresh thinking by experts, regulatory influences, and parallel development in the financial accounting standards and the like. So the generally accepted principles will always undergo change over a period based on the various practices that are being followed by the industry. Now we come to the cost accounting standards. So as I mentioned, there were as many as 13 cost accounting standards already in place when in 2011, when the generally accepted cost accounting principles were released by the institute. So the first standard talked about the overall classification of the costs. Then the capacity determination, the production and the operation overheads. Cost accounting standard number 4 was very much popular, especially during the excise regime, wherein the cost of production for captive consumption had to be certified by the cost accountants for related party transactions. Then the equalized cost of transportation, material cost, employee cost, cost of utilities, packing material cost, direct expenses. So all these individual cost element wise cost accounting standards were there in place by 2011 itself. And of course, these standards were also tweaked a bit based on the generally accepted cost accounting principles. And there were a few conflicts between these standards which were also removed at that time. and all the fresh standards from 14 onwards, which were introduced, are also following the generally accepted cost accounting principles. So there are 24 standards as on date in place, and there are a few more standards also under development, which will be released in due course of time. Now, typically, the structure of the cost accounting standards my screen is still visible.
No, sir.
No, sir.
Something went wrong.
No.
Just give me a minute. Yeah, are you able to see it now?
Yes, sir.
Okay. So there is a standardized structure for each and every cost accounting standard. So if you look at all the 24 cost accounting standards, they are basically given in 8 subsections. So section 1 will give you the introduction. It will, in brief, give out the details of the topic and its role in the cost statements. Then section number 2 talks about the objectives of the cost center. So what was the necessity of framing that particular standard will typically be given in the objectives section of the cost accounting standard. Then the scope of the standard and the applicability will be given in section 3. Various terminologies which are referred to in the standard, that particular standard, will always be given in section 4, that is the definitions. Section 5 will typically give the principles of that is the various principles applicable behind the ascertainment, determination and categorization of the elements of cost will be given in the principles of measurement. Then section 6 will talk about the assignment of cost, that is the basis of assignment of cost to the cost of product or the services. And finally, section 7 and 8 will give the presentation and the disclosures, that is how to present the cost accounting standard in any prescribed formats. And section 8 will be give the various disclosures that are required as you adhere to the particular standard that will bring about clarity to the objective of the cost accounting standard. So now, because of paucity of time, in the next few slides, I will only touch upon the various key standards and the key examples given in various standards, wherein we will notice that how the standards, especially the principles and the assignment of cost and of course the disclosures, are basically derived from the generally accepted cost accounting principles. So in the principles of measurement, the cost accounting standard number 5.3 specifically mentions that in case of self-manufactured components and sub-assemblies, they shall always be valued, including the direct material cost, the direct employee cost, direct expenses, factory overheads, and the share of administrative overheads relating to the production, but excluding the share of administrative overheads, finance cost, and the marketing overheads. So this particular 5.3 in the standard typically refers to cases wherein there are multiple units of a company, and the component which is manufactured in one of the units is transferred to the other. So this standard says that this is a self-manufactured component or sub-assembly, and it should be transferred at cost of production, in short. Because if you look at the cost sheet format, the cost of production will always include all the direct materials and the employee cost, direct expenses, factory overheads, and the share of administrative overheads relating to the production. Then the employee cost should typically include the gross pay, including all the allowances. Then the bonus, if it is payable as a statutory minimum or on a sharing of the surplus, it should also form a part of the employee cost. Remunerations which are payable to the managerial personnel, including the executive directors on board and other officers, should be a part and parcel of the employee cost. There is a explanation given to this in the standard, which says that the remuneration paid to non-executive directors shall not be a part of the employee cost, because they are typically not employees of the company, full-time employees of the company, but it should form a part of the administrative overheads. In the cost accounting standard number 1, classification of costs, there is a specific para 6.1.4 and 6.1.5 on the labor cost. So payments made to the employees, whether they are permanent or temporary, should be included in the labor cost. The labor cost should also include the salaries and wages paid to permanent employees, temporary employees, and also to employees of the contractor. So if there are certain employees which have been taken from a contractor for and deployed on our production line, the payments being done to those employees should also form a part of the labor cost. And the salaries and wages will include all the fringe benefits also, including the provident fund contributions, gratuity, ESI, overtime incentives, leave encashment, etc. Now, an explanation over here, there are instances where the contractor deploys his employees in our factory premises, but the payment to the contractor is always either done on employment basis, wherein the employees are deployed on the production line of the company, and the salary to them is paid routing through the contractor. In such a case, the salary will be included as a part and parcel of the employee cost or the labor cost. However, if the contract is such that the payment to the contractor is made on a piece basis, irrespective of the numbers that have been deployed by the contractor, then in such cases it will not form a part of the employee cost. It should be reported as a direct cost or direct expenses. There are cases wherein companies come up with VRS kind of schemes, wherein a lump sum is paid to the employees for his voluntary retirement. So in such cases, the cost accounting standard on the employee cost states that the separation cost relating to the voluntary retirement or retrenchment, termination, etc. Shall be amortized over a period benefiting from such costs. So the lump sum payment should not be charged to cost in the single year, but they should be charged over a period of the remaining useful life of that respective employee. Similarly, the cost of free housing or free conveyance and any other similar benefits which are provided to employees should be determined at the cost of all the resources consumed and reported as an employee cost. At the same time, any recovery which is done from the employee towards any such benefit like the housing or the travel or canteen should get reduced from the employee cost. and not reported separately as income. Similar to material, there are certain utilities which are generated during the manufacturing process. So the cost of the self-generated utilities for own consumption shall comprise of the direct cost, the direct employee cost. So if we take an example, typically there are certain industries wherein steam is required as a part of the manufacturing process, and the company typically has its own boiler which generates the steam and supplies it to the production lines. So the cost of steam which is generated in-house will typically include the input material. So there are cases wherein briquettes are used. Briquettes are purchased. They are burned in furnaces to generate heat, and then water is boiled and steam is generated using. So the cost of the briquettes, the cost of other consumables which go about the burning of those briquettes, then the plant and machinery which is involved, that is the boiler, any labor which is directly deployed for the steam generation, all these costs should be accumulated together and reported as utility cost. Similarly, in case of inter-unit transfers, as we saw in the material standard on the material cost, the distribution cost incurred for such transfers will be added to the cost of the utilities. In case of repairs and maintenance cost, the cost of in-house repairs and maintenance shall include the cost of material consumable. So as I mentioned, the overall principle will remain the same. Only typically in case of repairs and maintenance, what typically happens is that there are certain major expenses that are required to be incurred. So if at all there are any major expenses which enhance the overall life of the basic asset, then the cost of such major repairs and maintenance can be apportioned over the useful life of that asset. So the cost of spares which are replaced, which do not enhance the future economic benefits beyond its previously assessed standard of performance, can be charged during the same year. However, any high value spares which replace the spares, then and if it is expected to result in future economic benefits, then such high value spares should be amortized over a period over which the economic benefit is going to arise. Similarly, any cost of major overall can be amortized on a rational basis, provided it is going to increase the useful life of the basic asset. Then there are standards on the service cost centers. The cost of services for the purpose of inter-unit transfer will also include the distribution costs. So exactly similar like in case of utilities and the material cost. Then the cost of services for the purpose of intercompany transfer shall also include the distribution cost incurred and the administrative overheads relating to the rendering of that service. And in case of the services which are rendered to outside parties, then the cost will include the distribution cost, the administration overheads, and also the marketing overheads. So in case of intercompany or inter-unit transfers, only the administrative overheads are to be charged as a cost of production. And in case of sale to outside parties, the cost sheet will also include the marketing overheads. Then in case of assignment of cost, the traceability to the cost object in an economically feasible manner shall be the guiding principle. This is something which I explained earlier as well. And the cost which can be traced directly to a cost object can be directly assigned. the assignment of overheads to cost objects are typically based on one of the two principles. One is the cause and effect. So cause is the process or the operation or activity, and the effect is the incurrence of cost. So typically, if there is a specific requirement of any particular cost center or a particular product, because of which certain expenses are required to be incurred, then naturally the assignment of those expenses has to be on that particular cost center and naturally on that particular product. The second methodology is the benefits received. So in this case, the overheads are apportioned to various cost objects in the proportion of the benefits received by all of them. So where it is not possible to clearly identify the cause and effect, then on certain basis, based on the benefits received, the overheads is required to be apportioned to various cost objects. Then the overheads shall be analyzed into variable overheads and the fixed overheads. The various overheads are typically absorbed to products and services based on the actual capacity utilization, whereas the fixed overheads are absorbed to products or services on the basis of the normal capacity or actual capacity utilization, whichever is higher. So typically in cases where there is a lot of underutilization of capacity, the fixed overheads will be charged to actual production based on the normal capacity, which means there will be certain cost relating to the unutilized capacity, and the under absorption and the over absorption of the overheads, as the case may be, has to be reported as a reconciliation item in the P&L reconciliation. Then all the cost accounting standards specifically has a para on the disclosures. So these are typically the common disclosures which find a place in most of the cost accounting standards. These are listed out over here. That the basis of assignment of overheads to the cost objects has to be clearly mentioned. The cost or the overhead incurred in foreign exchange has to be disclosed separately. The cost and overheads relating to resources received from or supplied to related parties has to be disclosed separately. Any subsidy, grant, incentive, or any amount of similar nature receivable which is reduced from respective overheads has to be disclosed as a part of the disclosure after the cost records. Then the credits or recoveries relating to the overheads which are done say from employees has to be separately disclosed. Any abnormal costs which are identified and not forming part of the overheads should be separately disclosed, and these are typically reflected in the P&L reconciliation statements. So is any unabsorbed overheads. So in the earlier slide we saw that the fixed cost of underutilized capacity is typically not charged to the product, but it is separately disclosed and shown as a P&L reconciliation item. And the disclosures shall be made only where they are material. So the cause or the cost benefit analysis has to be done as we ensure the adherence to the cost accounting standards and the generally accepted cost accounting principles. Finally, the quantity and rates of major items in the material cost, that is items forming greater than 5% of the cost of material, shall be disclosed separately, and the basis of valuation of material shall also be disclosed. So whether we are following a weighted average or a FIFO method has to be disclosed separately in the disclosures. In case of repairs and maintenance, the cost of jobs done in-house. Yeah, someone is mic is on for someone. In case of repairs and maintenance, the cost of jobs done in-house and outsourced separately should be disclosed individually. And the cost of major overhauls or the asset category wise and the basis of amortization should be disclosed separately. So I think that's it about the cost accounting records and the cost audit rules 2014, the GACAP and the cost accounting standards. So I've tried to give overview of all these in my presentation. As I mentioned earlier, I do not have any exposure to the actual examinations of the UPSC. So the WRC has already identified some of the cost accountants who have passed the examination, and they will be giving 1 or 2 sessions separately. So if at all there are any specific questions relating to today's topic, I am happy to take them. Also, as I mentioned earlier, the cost auditing and assurance standards is a topic which is not covered today, which will also be taken on some along with some other topic on some other day. Because in the limited time of 2 hours, it would have been too much of the content. So that's it from me. Over to the organizers. I think Mihir Bhai is also joined the meeting.
Yes, sir. Thank you, sir.
I already there since starting of the series.
Okay.
Anyone has any question, please ask to Amit sir.
So first of all, thank you very much for the wonderful insights. I'm by profession at ICMAI-WIRC. I just want to know 2 points on this. Like when we have, and I'm working in the textile industry, so in this we have this asset based on the depreciation based on the utility of the asset. What would be the best way to charge the depreciation in the cost sheet? Second, we have that fair value loss and gain on our revaluation gain. So what will be the impact on that?
Varun, can you slightly elaborate how you are charging the depreciation currently? You mentioned the useful life. So does it mean that you have for each of the production lines and you have identified the major assets and you have worked out the useful life of those assets? And suppose the useful life is say 8 years, then you are charging the depreciation over a period of 8 years. That's the way you are doing it?
Sir, right now we are working like that only, but the problem we are facing is like in textile industry, we are working with 3 shifts and the asset is being depreciated based on the per unit of the production we are making out. So we are facing this difficulty with us.
Okay, so actually you are using a twin methodology, that you are calculating the life of the asset over a period and then charging it to the products that are based on the per unit manufactured during the year. So there will be under or over absorption for every year. That will be a challenge for you, depending upon the actual production, because your depreciation has been calculated for the year. But the depreciation is not being charged to all the products that have been manufactured, but you have worked out a standard production for every year, and then you are calculating the per unit cost and then charging it to the individual products. So naturally there will be some under or over absorption of the depreciation cost. Is that right?
Yeah, absolutely right, sir. Is there any other way we can tackle this out?
So what needs to be done is the capacity that you have calculated should be rationalized based on the actual capacity that you have achieved over the last maybe 3 years. This methodology is also given in the cost accounting standard number 2 on the capacity. And once you have done that, I think that is a rational way of doing it, because the only other way of doing it is charging the depreciation for the year on whatever production that you have done during the year, which may not be realistic. But at the same time, that is the way most of the industry charges depreciation to the products. That the depreciation for that particular year is always charged to the production that has been achieved during the year. Of course, depreciation being a fixed charge, the capacity utilization is taken into consideration. So naturally, if the normal capacity has been worked out, then the charge to individual product will always be based on the normal capacity, which is more or less similar to what you are doing. So I think you are following one of the practices that are being followed by the industry.
Okay, that's good, sir. And sir, what about this fair value gain of realization whenever we are revaluing our asset on the foreign exchange gain and loss?
The standards are pretty clear about that. Any forex gain or loss has to be reported as a reconciliation. It doesn't form a part of my cost of production. Even in case of you're referring to revaluation of the assets. Even in case of procurement of material, the value of my cost has to be taken on the date of the transaction. So on the date of the transaction, if the rate of the dollar is say 80 rupees, in the costing, I always consider 80 rupees as my cost. And suppose the terms say that I need to make the payment to the vendor at the end of 2 months. And at the end of 2 months, the dollar's rate is 82, which means that I have paid rupees 2 extra. So there is a capex loss in this case. So this 2 rupees capex loss is always shown as a P&L reconciliation item and does not affect my costing.
Okay, thank you very much.
Yeah.
Sir, I have one question.
Yeah.
Am I audible, sir?
Yes, Ritik.
Yes, please.
Sir, you are saying that interest and finance cost should not be a part of cost. If interest is taken, if loan is taken.
Wait.
No,
Before you complete, let me clarify. I never said that it will not be a part of the cost. I said that it will not be a cost of production. It will be a part of the cost of sale. Yeah. Now you can complete your question.
Sir, why should not be cost of production? For example, if we have taken loan for the purpose of our purpose of meeting our working capital requirement, we are taking loans. For example, you are taking the example of letter of credit. If we are taking loan for the purpose of our working capital requirements, for meeting the production target and all, so then it should be a part of cost of production. Is it possible?
So the standard clearly states that we should not take even though the allocation of the interest and finance cost to individual products will always depend on the purpose why you have taken the loan. The interest and the finance cost per se should not form a part of the basic cost of production. That is what the standards says. And I can give you a rationale. Why the standard has been designed in this particular manner. There are two comparable companies. I'm just giving you an example. One company is into heavy debts, and most of their capitalization has been done by taking bank loans. The other company is flush with funds because they have infused a lot of capital, equity capital. So they don't need as much funds in the form of loans. Now, both these companies are competitive companies and they are manufacturing similar products. Now, if you go naturally, because one company is debt ridden, their total cost of sale will be definitely higher than the cost of the second company. But at the same time, if you load the interest on the cost of production itself, then the cost of production of the first company will not be comparable with the second company. So yes, that is one of the rationales that must have gone into the thought process.
Okay.
Just because of the difference in the funding, the cost of production does not vary, should not vary.
Okay.
Yeah.
And sir, जैसे currently I'm working in healthcare sector, and we are basically understand the meaning of cost, nature of cost. Is it possible that हमें कुछ allocation करना हो तो cost के nature के basis पे कोई allocation हो जाए जहाँ पे कोई rule define ना हो? Like we are in service costing, activity based costing. So we are taking live examples that, for example, we are meeting service requirements. Like for example, किसी cost को allocate करने के लिए कोई like standard नहीं है, तो allocation का base cost के nature पे ही depend करेगा. जो allocation का cost driver होगा.
It will depend on the nature of the cost, and I mean this is a generic answer that I am giving you. If you want to get into specific, maybe I can take this up offline also. If you want some specific advice as to how to allocate a specific cost to individual products. Okay. But it will definitely, it will always depend on the nature of the cost.
Okay. And sir, can you give me a brief idea about that, about the exam, that this is pure professional, or is there any government exam also?
I will not have any idea. Maybe Mihir or WRC, you can throw some light on this.
Okay.
Sir, there is no date for the examination as of now.
Yes, sir. When will you tentative date?
सर वो पता नहीं रहता है, वो गवर्नमेंट डिसाइड करती है कब एग्जाम होगा. और एज लिमिट विल बी 35 इयर्स. मैंने क्वेश्चन किसका देखा था.
इनको टेंटेटिव डेट नहीं है, लास्ट 2022 में हुआ था.
हाँ, यस लास्ट 2022 में हुआ था. व्हाट इज योर एज?
My age is 23 years old.
So you have a lot of time.
Yes.
I have time, but yeah. And the session was
तो
very
advertise will declare. अभी एडवर्टाइज कोई आया नहीं है. इट विल डिपेंड ऑन द गवर्नमेंट रिक्वायरमेंट.
Okay. Yes.
Any other specific questions, or should we go for the vote of thanks? ठीक है सर. Good evening everyone. This side is CMA Mihir Vyas, Secretary of ICMAI-WIRC. Sir, in the welcome address, our chairman rightly said when Arindam by thinking about the series, of course, first name would be a CMA Amit Apte sir only. He is a very dynamic and past president of the ICMI. It has been such an honor to be a part of this wonderful series. On behalf of PD Committee ICMAI-WIRC, I would like to extend a really hearty vote of thanks to our today's speaker, CMA Amit Apte sir, for accepting our invitation on webinar series for UPSC ICOAS preparation for newly qualified CMS. Sir, today we had an opportunity to hear your thoughts and knowledge, and this will surely helpful to all young members and CMS. Thank you so much, sir. Also, I would like to sincere thank to our chairman CMA Chaitanya sir, Vice Chairman CMA Arindam Goswami, he is also PD Committee Chairman, and all the committee members of ICMAI-WIRC. Finally, I would like to thank all the present members for attending this event. Please stay with us. There are others topics also later on. So thank you so much, one and all.
Thank you, sir.
Thank you, sir.
Thank you, Mir. Yeah.
Thank you, Amit sir. Sir, can you set your PPT? That will help the students.
You can circulate it amongst all the. I will send the PPT.
Okay, sir.
Yeah.
Okay.
Sure, sir. Thank you so much, sir.
Thanks
Thank you,
all of
madam. Thank you, Tanmay sir.
Thank you, sir.
Thank you, sir.